Alright, so I want to discuss a few things before, while I have a little bit of time. And I'm going to start really discussing this very much in detail over many, many videos coming up soon. And that is probabilities. Everyone must understand every support and resistance level has a mathematical equation to it. Now I don't want to make that seem real complicated, so I want to give you just a simple summary of that. Every tick is derived or created by math. Support and resistance is simply math. Everything's a probability. It's the trader's equation that Al talks about, risk, reward, and probability. And I really believe, I'll just put it this way, traders will do better when they think in terms of math. The successful traders think in terms of math. And I mean, you can look at a chart and it just makes sense. The only explanation is math. For example, for the people who are struggling, I would say it's due to. So anyways, real quick, if I can, hope I can find this. I was just looking at something, and I think it'd bring a good example. Afraid I may have lost it. Well, right here, this works right over here. Everything's math, and Al can explain this a lot better than I can, and he has a video course that talks about this. So, as I'm sure I've said many times, I'm going to advocate his video course and say that that's probably the easiest way to learn it and understand this, what I'm about to say. Anyways, well, first let's take basic support and resistance and why does it work. See, there's support and resistance everywhere, so I think it's kind of flawed to try and find everything. You need to understand, I think understanding the logic behind why the support and resistance is around there is more important than just simply understanding that it's there. And here's why. Open of this day. Why did we rally up strong into the high? And it's obvious, we were at yesterday's low. So what's the rationale behind it? Well, it's simple in a way. On this open, we're at this low of yesterday. Theoretically, if you sell down here, where's your stop? Well, and this goes into trader's equation. You can always control your risk reward. You can never control probability, but you can use those to manipulate your probability. If I put my stop here and I sell the open of this bar, and let's pretend, well, let's just say this bar closes right here. And, well, before I say anything, the math changes with every tick. So there's no difference behind buying this close or buying this close. Accept that right now. I'll explain why later, but I need you for this demonstration to just accept that. And the reason I say that is it's because of math. Everything changes tick by tick. So if a trader sold here and now price is here, their only real stop choices is there's really a few. Stop one tick above, which is most logical, and I'll explain why. A stop up here, or stop way somewhere up here. So let's take this stop. Ask yourself, what are the odds that price at this close, if you sell here's protective stop up here, what are the odds price gets down to here before stopping you out? Well, in general, assume three different things. Assume probably, in other words, when you probably believe something will work, you think it's 60% probability, which means you can go for technically 1-to-1. If you think it's 50-50, then you need, preferably a 2-to-1. Technically speaking, if it's perfectly 50-50, you can do a 1.5, but I just assume 2-to-1. And if you think it's 40%, 40% basically means you don't think it'll work. So, and when you think 50-50, when you look at the trade and say, gee, well, I don't know, go here, go there, flip a coin, so to speak. That's 50-50. Here, this is probably, 40% chance. So if I sell here, stop up here, I need at least a 2-to-1. So I'm just going to assume this gives me 2-to-1. If I sold here, stop up here, target's down here. Here's why it's less than a 50-50 bet. And the reason for this, and by the way, this explains why Al talks the way he does in the trading room. One thing that I find it bothers me is people criticize Al for the way he's talking in the trading room, but he's talking in terms of math. And until you accept that, you can never look at a chart and say, there's always two sides, and here's why. Here's why he does it, but I'll explain that in a second. So you need a 2-to-1. It's less than 40% for this reason. Here's support and resistance. Let me just there we go. So right here, these lows are obvious support. Now, in general, most breakouts of trading ranges fail. So here's the bottom of the likely trading range. So let's assume there's a minimum of a 50% chance it will fail. It might be 60%. So let's take that logic for a minute. 50% chance it fails, maybe better than 60. So at this close, it's probably 60% chance or greater price is going to fail. So if that's the case, we already know bare minimum of a 40% chance price will get down to here and have a successful breakout. It may, in fact, be less than that. So, in other words, it doesn't make a great deal of sense to keep a stop up here because we're probably going higher. That is why Al says in trading ranges, buy low, sell high, and scalp. So a swing bear who's been short is going to get out one tick above here because the math is so bad for holding short, traders will exit. And the math is really good. We may test the high today. We may break out above. So, take this same logic and let's apply it. Let me just fix the scaling real quick. Let's apply it over here. So right here, just kind of blow. Well, I don't want to do that, but I'll just kind of blow it up over here. 2 bear bars down. Let's apply this logic. Always in short, it's okay to be short down here, but you've got to think to yourself. Always assume you need a 1-to-1. So if I sell, my stop's up here. Doesn't matter if I sold here, or below this bar, my stop's up here. Doesn't matter when I sold, because here's the deal. If I sold the open of the day and I now have 4 points profit, whatever here to here is, it does not matter. That money's in my account. So if price stops me out up here, this is why break even doesn't work. It's not a real thing. And mathematically it's okay. You can still make money using break even stops, but I think it doesn't make any mathematical sense to set a stop at break even. It's kind of like this. If I buy this close, if I buy down here and price goes all the way up to here and then price stops me out back at break even, I could say, oh well, I only lost commissions, I only lost $5 per contract or whatever your commission is. That's not true. I lost all the money up here because here's the deal. If Trader Joe buys up here, stop down here, he will trade a smaller position, but we may have the exact same risk. If it's in your account, it's in your account. So don't lie to yourself when you you get a good entry and you have a profit way down here, then you get stopped out later. No, that's not how trading works. Anyways, if you sell here, stop up here, 60%, you need a 1-to-1 at a minimum. Is this 60% chance we'll get down here? Well, maybe, but you've got to factor in some things. We're far away from the moving average, so I don't think it's 60. I think it's maybe 50-50, maybe. But probably the first reversal up will fail. Well, here's why a lot of traders get out on high 2 buys at the bottom of a trading range. And it has to do with risk. So if bears are short, stop up here. The first reversal up should fail. Then we get the second leg down. Now we get this bar that turns up. Take the math now. You have a second entry buy. It's less than 50-50 now, or it's probably less than, it's clearly less than 60% that price is going to get all the way down here. It was probably less than 60% over here. So you will have bulls who will buy this close, stop down here, set a target up here. Ask yourself two things. In fact, before you do that, ask yourself over here, would you rather sell this low one with a stop up here and a target at a 1-to-1? So in other words, would you rather sell this low, stop up here, target down here, or would you rather buy this low with a wide stop down here and target up here? Which one has better math? If you were forced to pick one or the other, which would you pick? And that's why thinking in terms of probabilities helps. Now, I know this probably for quite a few people, and it's not a bad thing if this seems really confusing of what I'm saying. It takes a while to think this way, but if you just take it with an open mind and just think about it, I think you'll agree that it makes sense. Let's make it much more simple. I don't want to make it too complicated. Why is buying it up here and putting a stop down here a bad thing? Well, and maybe it's not technically bad here, but it's not the best. See, before I go into that, I'm sure many people have heard the saying of, oh, I wouldn't buy up here unless I was already long down here. From a mathematical standpoint, think about what they're saying. Just think about it for a second. So someone would say, oh, well, let's just call this person Bob. Bob buys down here, and now they're all the way up here. And they would say, well, I'm willing to hold, to have an open profit, but I certainly would not buy up here if I did not already buy lower. So in essence, what he's saying is the math is bad to buy up here. He's in essence saying, if I buy now, I'll probably get, I think I'll lose money. So what he is saying is that he thinks the probability of him making a lot of money from here is not great. Well, then think about what he's saying. He needs to exit his trade because, a simple thing to ask yourself is, will I probably make money on this trade at every tick? Or, when you're long and you're trying to decide whether you should stay in a trade, ask yourself, would I buy right now up here? If the answer is no, you should probably get out. So, and let me go back to what I was saying. If a trader buys up here and they think this is a trend, their stop's probably maybe below here or here or here. So the low of the day, below this bar, or below the bull breakout. 3 choices. Well, I have to kind of go to the right so I can see it, or draw this measured move. If your stop's here and you're up here, you need a 1-to-1 at a minimum. Well, probably greater than 50-50 chance the breakout fails. Most breakouts fail. So the math is not good for that, because if it's a trading range, we're probably going to fall below this support because it's the most obvious. So next, what about up here? So I probably need a 2-to-1 risk reward up here, and that takes me all the way up here. And again, if the breakout fails, we may fall below here, or even the low of the day. So the math is very minimum. Well, what if we put a stop down here, and we bought up here. Can we get a 1-to-1? Well, again, you probably need a 2-to-1 because the risk isn't, the math isn't that great. If the breakout fails, we could easily fall down here. So really, the only way to make this math work really well is to put your stop down here and scale in, which in this case, a trader would have lost. So I'm not saying that it's a great way to scaling is the best way, because how do you manage this trade if we just kind of do that? And you can see one thing that happened. The smarter traders are, I got to kind of think, okay, so they buy up here and then they buy more above a bull bar. Well, look what happened. They couldn't even really get out. So the math is very marginal. It's not great. And they, so that is why a lot of traders, that's the whole concept of buy low, sell high, scalp. So to wrap this up, and this is the last thing I'm going to say, and I'm going to talk more about this, so please ask questions if you have any. A lot of traders, that's why a lot of traders will get out low here or here, because they have to reduce the risk, because the math is bad to keep a stop down here. They know that. Therefore, the math is better for them to sell, put a stop up here. So they will simply exit their trade. All right, that's all the time I have. Think in terms of math, and I'll get back to y'all. Thank you.